Hi, this is Christian Mcpherson from Mcpherson Financial Group, and welcome to our 2026 January market update. So starting off with current economic indicators, looking ahead into 2026, the data is showing an economy that is largely being carried by the consumer. While we are seeing some very real friction in specific areas, the core pillars of income and spending remain remarkably resilient. This is very much a mixed bag environment, but for now, the strengths are outweighing the weaknesses. The most encouraging signs are coming from real personal income and retail sales that are shown here on this chart. Despite ongoing talk of a slowdown, people are actually earning more after inflation, and more importantly, they are spending it. Since consumer spending makes up nearly 70% of GDP, these two indicators provide a very solid floor under the economy. We're also seeing a rebound in industrial production. After a period of stagnation, the physical side of the economy, manufacturing and energy, has moved back into expansion. This is a constructive signal for business confidence, as it suggests companies are moving beyond a wait and see mindset and beginning to deploy capital again. The two areas showing weakness are housing starts and the civilian labor force. Housing continues to feel the lagged effect of higher interest rates, which has slowed new construction. On the labor side, we are seeing some contraction largely driven by supply constraints, such as an aging population and fewer new workers entering the labor pool. Overall, this points to a period of stabilization. We're not in a runaway boom, but we are also not seeing broad-based recessionary signals. That said, a mixed environment like this does leave the economy more vulnerable to policy mistakes or external shocks, since there is no single engine firing at full strength. Now transitioning to consumer confidence. This chart highlights the relationship between sentiment and market performance. Consumer sentiment currently sits at 54, which is historically very low. Normally, readings at this level are associated with deep recessions. What makes this cycle unique is that this depressed sentiment is occurring alongside solid GDP growth and rising real wages. This disconnect creates what we call a sentiment gap. The economy has largely recovered, but households are still processing the sticker shock from inflation over the past few years. From an investment perspective, this gap has historically mattered. Data from JP Morgan shows that investing when sentiment is at its peaks has produced average 12-month returns of around 4%. Investing during sentiment troughs has historically generated returns north of 20%, as shown in this chart here. The risk, of course, is that if inflation were to re-accelerate or employment were to weaken meaningfully, sentiment could deteriorate further instead of recovering. Still, markets are forward-looking mechanisms. While the public tends to focus on the rearview mirror of inflation, markets are already pricing in the earnings growth expected for 2026, which makes sentiment a useful contrarian indicator. Now looking at the Federal Reserve rate outlook. After the volatility of the last 2 years, the Federal Reserve has moved policy into what they consider a neutral zone. We ended 2025 with 3 consecutive rate cuts, bringing the federal funds rate to a range of 3.5 to 3.75%. As we look ahead to 2026, the pace of cuts is expected to slow. The Fed's dot plot suggests just one additional quarter point cut for the year. While that might feel conservative relative to earlier market expectations, it actually reflects confidence in economic stability. The Fed has revised its 2026 growth outlook higher to approximately 2.3%. Inflation is expected to settle near about 2.5%. With unemployment projected around 4.4% and a neutral rate environment, policy is no longer designed to slow the economy, but it is also not actively stimulating growth. The key risk here is inflation persistence. If inflation proves stickier than expected, the Fed may need to hold rates higher for longer, which could pressure both valuations and interest-sensitive sectors. Now moving to the S&P 500's valuations. The S&P 500 is currently trading at a forward price-to-earnings ratio 22 times compared to a long-term average closer to 17 times. At first glance, that looks expensive. However, context does matter here. A significant portion of the index is now made up of high-growth technology and AI-driven companies, which command higher multiples due to faster expected earnings growth. Schiller's PE ratio tells a similar story on this chart here, sitting at 40 times compared to a historical average around 28. While this is elevated, today's environment differs from prior extremes in one important way. These companies are highly profitable, generate significant free cash flow, and are investing heavily in long-term infrastructure such as data centers. For 2026, earnings growth is projected around 15%. If earnings meet expectations, current valuations become more defensible. However, elevated valuations also mean there is less margin for error. If earnings disappoint, even modestly, market pullbacks could be sharper than investors have grown accustomed to. Now moving on to AI growth and market broadening. For the past few years, market performance has been driven by a small group of companies, often referred to as the Magnificent Seven. As we enter into 2026, we're beginning to see a structural shift toward broader participation. While AI remains the core growth engine, returns are no longer concentrated in just a handful of stocks. Performance dispersion within the top names has increased, and earnings growth across the rest of the market is accelerating. Moving forward to our outlook of the market broadening outside of just your Magnificent Seven in 2026, and moving on to the S&P 493, which is the rest of the S&P 500. It is expected to deliver growth approaching 15% in 2026, while the Magnificent Seven to settle into still strong but less extreme growth rates. At the same time, sectors like healthcare, financials, and industrials are increasingly integrating AI to improve efficiency and margins. The risk here is execution. Market broadening only holds if earnings growth materializes across sectors rather than remaining theoretical. Now transitioning to investing at all-time highs. We do get this question quite often. Market highs often trigger emotional responses, but historically they are a normal feature of bull markets. Since early 2025, the S&P 500 has reached dozens of all-time highs. Notably, about 1/3 of all-time highs become long-term floors, meaning the market never falls more than 5% below those levels again. Investing on days when market hit new all-time highs has historically produced returns that meet or exceed investing on any random day. This does not eliminate short-term volatility, it reframes it as normal cost of long-term participation rather than a warning signal. If you look at this chart from a 3-month, a 6-month, a 1-year, all the way to a 5-year period, you can see how investing on a new all-time high versus investing on any day has performed comparatively, to where investing at an all-time high has outperformed, especially the longer time you go. Now, to bring everything together, we look at GDP. Consumption represents roughly 68% of the US economy and has been the dominant contributor to growth. Recent data shows consumption contributing well above its long-term average, reinforcing the theme of consumer-driven stability. Business investment has also contributed positively, while inventories and net exports have been more volatile. If consumption slows meaningfully, there is not yet another component large enough to fully offset the drag. For now, however, the mix of growth remains diversified enough to support continued expansion. We have seen GDP continue to increase over the last year in a positive manner that is pushing us forward towards growth moving forward. To conclude, we have made targeted portfolio adjustments to align with this environment. We increase international exposure to capture more attractive valuations abroad. Domestically, we adjusted factor exposure by adding momentum in small caps and reinforcing value tilts where appropriate. For income-focused strategies, we incorporated covered calls to enhance cash flow while maintaining equity exposure. In fixed income, we extended duration modestly to lock in yields now that policy has stabilized. These changes are not based on a perfect outcome. They are designed to perform across a range of scenarios, including slower growth, higher volatility, or delayed rate cuts. Our objective remains the same: stay invested, stay disciplined, and position portfolios to adapt rather than to react. Thank you guys for watching. If you have any questions, definitely don't hesitate to reach out to Art or me, or give us a call at 321-253-2016. Thank you so much and have a great day.